Good morning, everyone, and welcome to another edition of Market Professionals interview with market participants who have assets under management and who are doing this for a living full time and have expertise that we are interested in finding out more about and learning about how we can integrate what they know and what they do with what we know and what we do. The community of traders is a much stronger one when we synergize our talents. So without further ado, let us reveal the next market professional. All right, folks, we are here with the Thompson brothers, Matt and Mike. And the only reason I said Matt's name first is because alphabetically, he comes first. Now,
That's true.
in all other ways, they're equal, but I'll let them hash that out. Anyway, this is Thompson Capital Management. They are the principals, and they have their offices in Chicago, correct, gentlemen?
That's right.
Yep.
And that is a home office, is that correct?
Right. We have a home office and we have a downtown presence as well.
Fantastic. That's great. Diversification. That's what it's all about in markets. And we're here today to discuss with them their approach to investing and trading the market, and specifically as it relates to volatility, and even more specifically as it relates to the VIX and their somewhat proprietary approach to utilizing the VIX in their investing and trading strategies. And in a nutshell, on their website, which is thompsoncm.com. That's THOMPSONCM.com, which, by the way, is one of the most beautiful websites I have ever seen. And I'm super jealous, but that's for another interview. So on their website, on their homepage, blending extensive portfolio management experience with deep expertise in Chicago's homegrown VIX marketplace, we build strategies that make portfolios more resilient. That is poetic. All right, guys, we got you here. First question I have for you: who's the brains and who's the brawn?
That's a tough one. We're getting right into the family squabbles here.
We missed the bronze section of the CFA, I guess.
All right, fair enough. Okay, that's cool. That is actually my first question in the pre-interview that I had with Matt. He introduced an acronym that I had never heard of in my 30 years of market experience, and that is CFA. Initially, could you just give us a quick rundown on what CFA is and what you need to do to acquire that acronym at the end of your names?
Sure. It's called Chartered Financial Analyst, and it's a program where it's essentially like an MBA where it covers every topic in finance that you can think of, and there's a series of 3 tests that you have to pass over a minimum of 3 years to be able to earn that designation.
Wow. And both of you have that certification or that designation?
We do. Yeah. We took off 3 summers of fun for getting that designation.
Oh my. Okay. All right. So there's the cred, folks. They've done their work, their homework. They put in their time in a big way. Taking 3 summers off. Oh my gosh. Okay. Well, with that being said, first and foremost, how long have you all been involved in the financial markets?
So this is Mike. I'm the older brother, so I've been in the market slightly longer than Matt by about 3 years. But started in the industry in '96 at Northern Trust.
Wow. Okay. So you've got about 23 years of experience there, and
Yep.
You came in right in the middle of the .com boom. All right. And markets were flying at that time. I remember that well.
Yeah,
and,
very interesting time.
Yeah, absolutely. And that invites the question that I had discussed with Matt regarding the long side versus the short side of the market, and how you kind of went through a revelation of sorts at one point. You mind discussing that, Matt?
Sure. Yeah. So as Mike mentioned, we started on the traditional kind of buy side of the world, picking stocks and benchmarking to an index. And over the course of our careers, we ended up drifting more towards the derivative side of the world. And really, the light bulb turned on for us as we were doing business development at a startup derivatives exchange in Chicago in '07. And so, talking to hedge funds and prop shops and into the way they viewed the world and how they traded was light years different than the way, say a Northern Trust looked at the markets. And then in 2008, when we got to a family office, having come right off that experience, and we got some R&D budget, and then 2008 happened, and there was a bit of volatility in that year, and so that kind of that's where our strategy was born out of. So we were trying to get away from being reliant on the market going up to make money.
Anything to add to that, Mike?
Yeah, I think, it took, as a newbie in the business in '96, I think it took, a couple bouts of volatility to realize what a long equity position is a, tacit short vol position. So I think, it took probably a year or two for kind of a new person in the business to realize that, but that's definitely helped. That realization has definitely helped shape the investment approach that Matt and I have had over the years.
Cool. It only took you a year or two? Wow.
Yeah, I mean, nothing really happened when I first started except for stocks going up until, August '98 was kind of the first real disturbance in the force.
Well said. So as it relates to volatility, and obviously getting your fair share of it in the dot-com bust, as well as the financial crisis, 2008, is that what would you say was the beginning of your attention / focus on volatility, and when you began incorporating it into your trading style, your investment approach?
Sure. For me, it began probably right after the dot-com and NASDAQ peak in March of 2000. I was working at William Blair at the time in Chicago, and it started a couple years of tougher, index performance, which obviously makes all equity performance more difficult. So at that time I was looking around for something to give me kind of an edge in what we were doing in terms of equity investing at Blair. So back then is when I got my Series 4, which is the option principle test.
Cool.
No one else on our floor had it, so it was a active self-preservation, if you will.
Job security.
Yeah, exactly, or an attempt at one.
Right.
So I started doing option-based strategies for their core equity approaches at that time. So I would say we were volatility aware in the early 2000s.
Okay, and then
more specifically was 2008. Obviously, that was sort of the gold standard for a volatile market.
Boy, oh boy.
Still is for us. And it was around that time, right after 2008, is when the volatility ETFs and ETNs listed.
Mm-hmm.
So that's more specifically in 2009 is when we started getting into the VIX futures and understanding how a term structure affects outcomes in those ETFs, and our strategy was sort of born out of that.
So when did you begin to understand and begin to kind of mentally extrapolate how you could utilize volatility to make money?
Yeah, sort of our light bulb moment, if you will.
Yeah, I love that. Yeah, exactly.
Yeah, I would harken back to that same period Matt just mentioned, kind of 2008, 2009. We were running a multi-asset class hedge fund for this family office. One of the sleeves or allocations in that hedge fund was volatility.
Oh.
And, we had been aware of the tradable VIX market since pretty early on. Matt, do you remember when we were at the place prior to the family office, we were trying to get UBS to do a VIX structured note for us?
Yep. Yeah, I remember that well.
Yeah, and, no one could figure it out at that time because I think that was only when VIX futures were trading in 07. I think VIX options came on in 06. So anyway, we couldn't get that done. So we already were intrigued by volatility as an asset class on its own. It was back in 06, 07. So in the family office hedge fund, we had that as a standalone asset class. Right next to that, we had commodities as a standalone asset class. And we were using a lot of those ETFs and ETNs that played in commodities, where the only tradable market were futures for nat gas, let's say, or crude oil.
Mm-hmm.
So in those notes and ETFs, we noticed tracking error between what the notes were doing and what a continuous futures contract was doing. We realized it was down to the rolling mechanics and the just structural expense of the futures market, rolling your contracts to maintain exposure.
Mm-hmm.
So that was at the beginning. I would say that's where like 20 watts of the 60 watt light bulb moment went on. And then when those VIX cash ETNs and ETFs listed in 2009, the additional 40 watts went on for us as we realized, hey, VIX is a perfectly mean reverting system. We know its mean price, we know its median price, and it operates in the same type of structurally expensive futures market as the tradable market. This thing probably lends itself really well to statistical analysis and quantitative analysis. So that was the kind of the whole evolution of the idea where we wound up now.
So just a point of clarification. So you obviously became not only aware, but I would go as far as to say, based on what I'm hearing you say, excited about understanding the volatility complex more intimately so that you could utilize it as a trading/investing vehicle. Did you treat it initially as a hedge instrument, or was it always something that you just looked at overtly and proactively as a trading component of your portfolio?
Yes. Initially, we did treat it as a hedge. It was in that multi-asset class allocation fund. We had it as an allocation when our risk off type signals were happening. We would go out and buy some volatility because it made sense to us. If you're under a declining moving average and volatility is rising, why not go own some of it in the form of these ETFs? And it was in that sort of entry where we started to look at, okay, well, this is what I expected from this ETF and this is what I received. And the difference there started, the whole process Mike just described.
Wow, I really have to give you guys high marks for being able to, really do the deep dive into the analysis of the volatility complex, because, I'm still a little scrambled about the entirety of it. I mean, I'm getting better, but, I would say probably 10, 12 years is when I've really been, focused on it as an asset class.
Mm-hmm.
And I don't know, I still love the space. I still find enormous value in it, and it helps me with my other trades and investments as well, by being able to evaluate the market in a way that, I mean, it's a technical indicator for me. So it's a very, very powerful instrument. So when we look at a year like 2017, where we made new lows in the VIX and things were just meh as it relates to volatility, what did you guys do? How did you manage your portfolios as it relates to volatility that year? And were you concerned at all at any point in time, due to the new lows being put in, that there was going to be a Volmageddon, if you will?
Well, for me, I was definitely surprised to see, especially after what happened on election night in 2016, yes, and all of the prognostications at that point. This is going to be the most volatile market you've ever seen, and then it immediately goes to the most calm market you've ever seen.
Exactly.
I thought that was pretty ironic, but I think the way we looked at it that year was that the VIX was very low. I was surprised that I would see an 8-handle VIX. On the other hand, realized volatility in the S&P was similarly very low. Mm-hmm. So it was, in our view, that was justified, those low levels, just relative to realized volatility. And so we looked at it like, okay, this is a very low deck, and there is some risk in an 8 VIX. It can double very easily. But the same structural pieces were there, where the implied vol was higher than realized vol. Mm-hmm. And that's sort of what we're after in our trade. So we were able to make money in 2017. And with a short vol trade, you just have to be more cognizant of your position sizing and just manage your risk better.
So, I mean, that statement alone, Matt, really, speaks to the idea that you not only understand volatility, but you've got it dedicated to your intuition almost in that regard. I mean, that's really powerful stuff. So as it relates to February of 2018, did you guys on any level see it coming, concerned about the over short dedication in the market in volatility? Was there anything that, well, to use Mike's term, kind of made a light bulb go off?
Well, I mean, I'll jump in here that we didn't expect it to happen on February 5th of 2018. There was no.
Really?
I'm not going to come out and say that.
Okay.
We definitely were tracking the warning signs that were all there. As of January of 2018, I did an interview actually about that topic of what would it take for XIV to go to zero? And that was my interview, January 2018. I sort of laid out some ideas about what that might look like. And I had no idea, a few weeks later it was going to actually happen. But what we were tracking at the time in January 2018, it made us a bit concerned and backed us away from XIV and all the short instruments. Actually was the term structure was giving us some warning signals, the classic ones, flattening up and lifting. And then B, more structurally, we tracked the open interest in XIV and SVIXI, the short instruments. And they actually, the open interest in those instruments got to be bigger than the open interest in the long side, which is historically very unusual. In addition, they were beginning to kind of crowd out the market. They were 30 or 40% of the open interest of overall VIX futures. Wow. And so there's a lot of money concentrated in there, and they have to index and they have to reset on a specific schedule that everybody in the market knows. They write it out in the prospectus.
Yeah.
You could sort of see all of those pieces coming in place. So we were nervous in January 2018. I was not calling for that to happen. What do you think?
Fair enough. Wow. Mike, anything you want to add to that?
Yeah, I think there was enough happening towards the end of January that started having our VIX-based signals give us the heads up or the warning that vol was going to rise. The magnitude and the specific date, like Matt mentioned, are not part of a system like that. But if you looked back in January, after the January VIX expiration, spot VIX and S&P rose almost the entire back half of the month together, and then S&P started selling off. So there was enough. The barometric pressure dropped. Like the warning or the conditions were right for bad weather to come ashore.
Is the spelling on barometric BEARON?
Yeah, for your purposes, absolutely. Like Matt mentioned, we tracked the AUM in those ETNs and ETFs, both long and inverse, in the leverage ones. You can see the intrinsic value of XIV breaking apart from the price of its note back then. Wow. In January. So that had done that in the past. So it didn't always mean Armageddon was in front of us, but it was just like another sort of piece of the mosaic theory, if you will, that came into place back in January. That should have given you caution, reduce position sizes, or hedge or go to cash, so it didn't catch you out on the Armageddon.
Now, you have, how much AUM do you have?
We're at 85 million.
85 million assets under management. Okay.
Correct.
So, and that is approximately how many clients?
Individual clients, we're probably in the 400 range. So
okay. And do you provide a newsletter that goes out, or any kind of, periodic scheduled information that is
Yeah, we provide monthly updates on our website. Okay. You can go out to the thoughts section on our website. We put stuff
Perfect. So just so when you were having this concern in January, was this something that you brought to the fore for your clients?
So not in the monthly update specifically, but in the media section of our website, you can go see the interview I did in January.
Perfect.
And again, that was something that it was sort of timely because those instruments had done so well in 2017 and we're getting
Right.
a lot of attention. Anything that's up a couple 100% in a year is going to get some attention. And
it's like a little overstretched maybe. Huh?
Yeah.
So we just wanted to get out there and just talk about what the risks of the instrument were.
Very cool. All right. So you alluded to your indicators. Now, we talked initially, Matt, about an instrument that you've developed. Would you like to talk about that a little bit?
Sure. It's called our volatility dashboard. And all that is it's not a trading system where it's shooting algorithmic orders into the market. We're not coders that way. All it is a way to organize all of the information that's being spit out from the VIX market. We think there's a lot of information in that market. It's sort of where the world goes to hedge risk. I think that's actually SIBO's tagline even.
That's good. I like that.
So our philosophy is with the dashboard, we can quantify what the VIX market is telling us on any one day about the risk environment. And then from that message, we can do different things in our portfolios. We can increase exposure or decrease exposure to the market.
Now, is that volatility dashboard available to the general public for a subscription, or is that specifically for your use only?
That is specifically for our use right now. We do offer a signal service where you can sort of, I will publish the trades I'm making in our VIX program based off of that model.
And what does that subscription service cost?
Right now we're doing that for $250 a month.
Okay. And approximately how often would you be providing signals, as you put it?
Well, it's real time as we trade our system. So, it goes out with an email blast and it varies with the market. So in a month like December, we're going to be a lot more active than maybe some months in 2017 when we were sort of just watching, nothing happened.
Fascinating. And do you offer a free trial for that?
Sure, we would do that.
Okay. Now, we've talked a lot about short volatility. What do you guys do, if anything, as it relates to long volatility? Is that a tradable market approach for you? Or?
Yes, that's a much harder trade. It's catching lightning in a bottle, if you will.
Well said. You guys are just full of analogies.
So our main signaling for getting long volatility is if we see an inverted VIX futures curve, or one that is heading towards inversion. So that's a pretty reliable indicator to start a long vol position, but how you do it and how you manage it is really everything.
Now, is this what would be commonly referred to as backwardation?
Yes.
In the term future?
Yeah, that's right.
The term structure, I mean? Okay, great. So you look for that approaching, or you wait for it to actually occur?
Well, approaching is, we start to, generally we'll scale in as it approaches backwardation. And then this has sort of changed over the years, I think, as the volatility market has matured, and there's been more of this back and forth trading where maybe in 2008 you could wait until backwardation, buy volatility, and you would have done well in 2008 with that approach. I think today the way the trade is more back and forth, you need to be more nimble and get on it a little sooner.
I think you're a little too diplomatic, back and forth. I call it chop and slop.
Chop and slop, yeah. That makes sense too.
Rip and dip, just use it. I think the days of what is it? BTFD. There's all sorts of acronyms out there for
right.
By the
bull market and acronyms.
Yes, precisely, exactly. So as it relates to the market being, well, dare I say, unpredictable, more so than ever. Due to the news cycle and the big one, the Fed. This is more of an opinion question than anything. Obviously, there's no way to factor in the Fed per se. There are instruments like the Fed Fund Futures, and the like that give us a little bit of foreshadowing. But as it relates to the Fed and where we currently are in this, and at the risk of sounding super trite, new normal market where the news flow is basically running the show. How do you guys, are you just kind of, not even really watching / listening and looking at your indicators, or, what are you doing with all this?
I think the sort of like the Fed and normal news flow, our general approach is that the opinion is in the price of our market already, just like it's in the price of equities to a large extent.
Okay, Mike, that's way too intelligent of an answer. Need something more creative from it.
Yeah, I would say that the bigger kind of pain in the neck is trying to trade by tweet. So when Trump drops market moving news on Twitter, that catches people off guard. That's really, kind of a new paradigm in equity trading, fixed income, whatever it is. You generally don't have as a verbose president that's dropping market moving news on Twitter at random intervals. So that was really, that really encapsulated the month of May.
Right. I think
it did.
Absolutely. In my opinion, it was the spin cycle.
Yeah. Oh, no, that's good. I like that. Yet another analogy. I love that. So we've been through a few bouts of volatility lately, as you just stated, back in May. Now, I'm kind of a technical analyst, and certainly the fundamentals are always important. The economic conditions, where we're at with, interest rates, speaking of the bond market, which has been a little out of control lately, inversion of the yield curve, yada, yada, yada. If we look at our low of last December and we look at the move up until basically May 1, we see almost a market run amok to the upside with just a couple of very small pullbacks. From a technical analysis standpoint, we were way overdue for a fairly decent pullback. Now, markets don't pull back just because we need a pullback. Markets usually pull back on some kind of situation, some sort of negative news or negative circumstances, or at least perceived negative news or negative circumstances or uncertainty. We have all of that. Yet we had a very nice recovery, not this last week, but the week before this last week.
Right.
What do you attribute that move up to? Over being oversold, or a buy on the dip, or was your volatility indicator showing you or telling you something?
So what I noticed in May was, despite the fact that S&P sold off so dramatically, the VIX actually made its high for the month back on May 7th, and the S&P made its low for the month basically at the end of the month.
Yeah.
So the VIX barely looked over 20. The curve was contango, which is normally a kind of an all clear signal for us. So the VIX market was telling us, yeah, we've seen this before in the S&P, not too worried about this. I'm not going to scramble for a hedge today to take care of it. So you had this oversold situation at the end of May, and then I think really what turned it for the market specifically was rate cuts being openly discussed, and maybe even this summer. And so they really, all of a sudden, there's this real possibility of a rate cut. I think that's kind of what turned the sentiment enough to, in that oversold condition, to pop the market.
That's tremendous. You relied on your old tried and true indicators and looked at the market through the lens of what you always looked at it, and it gave you the information you were looking for. That's fantastic.
Right. Wayne, isn't the old saying, technicals first and news later?
So I have my own what I'd like to call proprietary approach to that. Thank you for asking, Mike. Okay, now you're getting your earful. No, I'll keep it short. I believe that most traders believe that there are technicals, and most traders and other traders believe that there are fundamentals. And then the two are, they work in tandem to some degree. It's the chicken and egg thing a lot of times.
Right.
My belief is that there's this gray area that exists between the two where they quite literally do kind of have a merging dynamic. And I use technical indicators that I have been able to show and prove do foreshadow the future movement of the market. And utilizing that level of technical analysis with utilizing the volatility complex really gives an edge to what I do and how I do what I do as it relates to trading and investing in the market. Now, I think what you guys are doing is a little bit deeper of a dive and a little bit more intricate. And I really want to know more about this volatility dashboard because part of my issue has always been aggregating everything. And it sounds like that's what you guys do. But this gray area that exists between technicals and fundamentals, I believe, is kind of one, they're kind of two sides of the same coin.
Right.
And they both have kind of a destiny, if you will, that ultimately combines. And so, there you go. That maybe doesn't answer your question, Mike. I apologize, but
yeah, no, that's very much on the same wavelength of what I was thinking.
Cool. All right, that's awesome. So speaking of rate cuts, there is a school of thought out there that if we do get a rate cut, the market's going to dive.
Right.
You guys.
Yeah, I mean, well, there's precedent for both.
Yes, exactly. Right.
There's the 95 scenario. They took out an insurance rate cut, or it was perceived as an insurance rate cut. Mm-hmm. And then there's the 07 scenario where rate cuts were far too late to save anything. So, it remains to be seen which one this is, if it happens. Goldman's out there saying they're not going to cut rates.
I read that and I thought, they're trying to get, that's clickbait. That's totally clickbait. There's no way.
Yeah.
So obviously the July meeting is the one where everyone thinks we're going to get cut. What do you think happens if we cut next week, or if it gets cut next week?
Yeah, I think net, in my opinion, I don't think it's good for the Fed's credibility because they're pretty invested in this term patient, inappropriate. Next week seems too soon to me. I didn't see where Fed Fund futures went out yesterday, but I would find it hard to believe that the June meeting is above 50% chance of a rate cut just because it's too soon. Like, this rate cut narrative needs more time to be around for it to be accepted. The July meeting looks to me like it's like 60% chance. I think I read the other day the Fed's never not cut rates going into a meeting where the Fed Fund futures said greater than 50% chance. Exactly. I think June, if they did it in June, it would be perceived as like too quick on the trigger, and maybe a whiff of panic by the Fed, so it'd dent their credibility.
Fair enough. My 2 cents on that. And actually, Matt, what do you concur with Mike, or do you have a different perspective? Or
well, no, I concur. I think that they're eventually going to cut rates, and as Mike mentioned, they need to be careful not to make it look panicky. And I think rushing to do a June one would definitely skew that way. And then my general template is that the market's going to be excited about the first rate cut or two, and probably head higher on that.
Yeah.
As long as it is in this the right time frame, and as long as earnings don't completely collapse or something beforehand where it's perceived all of a sudden they're way behind.
Yeah. The timing of the June meeting is not good for them to cut rates because it's in front of the G20. So that's a very, very convenient excuse or explanation to delay rate cuts pending the outcome of the G20.
So I had a conversation with Seth yesterday. He's president of Finom Group and with whom I work. And my thinking is that the Fed could actually stimulate some positive sentiment going into the G20 by sparking Trump's happier side by cutting interest rates.
Wait, he has one?
You see it every once in a while. It's usually when he gets what he wants, and what he wants is lower rates, and he wants lower oil prices, and he wants a lot of things, I know. But as it relates to this conversation, I know he wants lower rates. So if he gets lower rates before he goes to the G20, that could set the stage for him feeling a little generous, a little altruistic, maybe giving a little bit, which you can always take back, I know. But at any rate, that is just kind of a little speculation on my part.
That's I think that's valid. They could also probably do that with not an actual cut, but in the forecasting language, in the outlook, that kind of thing, and make it, wink, wink, we're on our way there.
And that comment
Right.
alone is why they pay you the big bucks, Matt.
Yeah. And
Exactly.
it could be like the most dovish rate hold ever.
Yeah,
That's right.
let's see that.
That was, man, you know, I like you guys. You really, you know, I'm learning a lot about conversational skills here. That's fantastic. Okay, so getting back to volatility specifically, if there's anything that you think most investors misunderstand about volatility, what would that be based on your market experience and your interactions with other traders, market professionals, even the general public?
Mike, you want to take that one?
Yeah, well, I'll take the first stab at it. So a couple things. You know, we've been in the volatility space for a while, so we've probably had several common themes of misperception. I think the branding, unintentional branding of the VIX as the fear index is probably one of the broader, you know, misunderstandings of the VIX market. The perception that the VIX is a wild animal, you know, ready to rip people's faces off on the upside and, you know, gap up to 1,000, that kind of thing. You know, if you look at the longer term chart of the VIX, 2-3 year chart, that kind of thing, it's got far lower volatility than the S&P 500. You know, the VIX index is just a stat. It's not an index that's meant to track economic progress or make price appreciation progress over time. I think the obsession or the view of volatility through flat price is probably a poor way to look at what the volatility market is trying to tell you, or what the participants in the options market are paying. A VIX of 24 can be cheap or expensive.
Awesome.
At the same price. You know, a VIX at 12 can be expensive even though the price is low. So I think those are probably the bigger, broader misconceptions of the vol market in general that I've seen over the years.
And that's a concept that's probably even more difficult to integrate and digest mentally than
It is.
you can short the market without owning something. It's like, what?
Right.
A VIX at any particular level can be expensive or cheap depending on other factors. I love that. Really.
Right.
Yeah, there's a time element in any VIX position.
Absolutely.
The things that you own, if you're trying to trade VIX, they've got a shelf life, and so that is really important to how your trade will work out over time, or how it will change over time.
Tremendous. Every once in a while, and most usually on CNBC or, you know, one of the news stations, you'll hear something about the VIX is broken.
Right.
Obviously, I discount that, but you know, where did that come from? Just a complete and total misunderstanding of volatility in the VIX specifically, or is there some kind of a reference point for that comment?
Well, I think those types of comments come from confusion. The VIX can be confusing sometimes. You know, usually, you know, the SIBO talks about the negative correlation of the VIX and the S&P. That is the point of that market. It's not minus 100% on every time frame, though. Sometimes the VIX will go up on a day when the market goes up, or you know, just recently did that a few times last week, I believe, and vice versa. And so it's around those times in that confusion where, hey, I'm expecting this index to act like this all the time in every time frame, and then it doesn't do that. You know, the default would just be to say, well, this doesn't work, or it's broken.
Yeah, Wayne, you know that old saying, it's easier to be critical than correct?
Exactly. That's exactly what
I think saying the VIX broken is the kind of the easier way out, or the you know, it's easier just to say it's broken than to look into the intricacies or the reasons why it didn't meet that particular person's expectations.
Right.
When has anything in the market ever met anyone's expectations?
Yeah,
in a textbook.
What the market does, it defies expectations.
Yes, exactly. The fact, I mean, one of my credos for the market is expect the unexpected, for crying out loud.
Yeah.
Sure.
You have to. I mean, you never know what's going to happen, especially with weekend risk anymore. So, which means I lightened up yesterday a little bit, but that's okay. That's another story. Wow, guys, this has been an incredible, back and forth here. I mean, I could keep going. I know you guys have plans for the day, and I just, would really love to keep going here because, a conversation about volatility and markets, that's the next best thing to trading and investing,
Right.
live with the market. Anything that you feel would be important to add, from your own perspective, or maybe points we didn't touch on?
I think our overarching message and philosophy is that in volatility, it's very important not to be a one-trick pony. If you're always short or if you're always long, it's our view that you're eventually going to lose money doing that. You need to be dynamic about volatility. You need to be. It's always in a cycle. There's never one kind of setting that works all the time, and so that's really our overarching message, is that you need to be aware of those volatility cycles and react.
Cool. So I, in addition to being, technical analysis, biased, if you will, I'm also options market biased.
Mm-hmm.
And are you guys trading options at all in your portfolios, or?
So we do trade options. Our main VIX strategy is just in the ETF. So it's an inverse or a long VIX ETF. Okay. But we do have other strategies where we do the VIX options as well, and options on the ETFs.
All right, very good. Any thoughts or comments in closing for you, Mike?
Yeah, I think, echoing Matt's thoughts on the overarching philosophy that you need to be dynamic in any volatility trading. You can be a short vol only trader, but it's very analogous to the options market. Options should be sold, just not all options. So right. There's, times to be short vol. That doesn't mean you should be short volatility all the time.
Right.
So even if you're a dedicated short vol trader, sort of identify or know the places where the edge in that trade is not worth the risk. And it's basically the same idea if you're a long vol trader. Know how to manage that cost to carry, waiting for the lightning in the bottle to strike.
Perfect. Fantastic, gentlemen. I definitely would like to have you back again, maybe after the next bout of volatility.
All right.
Right.
How you all did and how you prepared for it, and how you made out with it.
Okay.
So that is our interview with the Thompson brothers, Matt and Mike. And maybe next time they'll make the decision about the brains and brawn question. We'll nail that down in the meantime.
Right.
All right, guys. Meanwhile, on Twitter, I know, Matt, you're the one who's the Twitter sphere guy.
Yeah, right.
And, what your Twitter handle is?
@DynamicVol.
DYNAMICVOL.
Right.
Very good. And again, their website is THOMPSONCM.com. You gotta go there just to see the website. The bonus.
I moonlight as a web designer. Yeah.
It is just beautiful, man. I tell you.
Thank you.
Anyway, absolutely. Guys, thanks so much. I appreciate you taking a little bit of time out of your weekend to provide this interview, and certainly to provide your expertise. And I'll be looking you up for that volatility dashboard for sure.
All right.
So,
all right, Wayne.
Appreciate it. Take care. Bye-bye.
Yeah, thanks for having us on. Take care.
Absolutely. All right, folks. So that was a very powerful interview with the Thompson brothers and Thompson Capital Management. And really appreciate you taking the time to view this video and to learn a little bit more about the volatility complex. And I am Wayne Nelson, and on behalf of Seth Golden and Finom Group, take good care, have a great day, and as always, trade safe.